Okay, go away. You are definitely on something. Let me concentrate on today's episode, which is mutual fund versus ETFs. Okay. Hey guys, Daniel here. Today's episode is all about giving you the fundamental knowledge for those of you who want to start investing but don't know where to start. Maybe heard about different terminology like mutual funds or ETFs, but don't know what is the difference between the two and which one should I select. So, are you ready? Let's get started. Hey guys, if this is your first time visiting my channel is all about helping you achieve your most important financial goals. Again, my name is Daniel Lungu, I'm a financial advisor, and this channel is all about providing you with tips and advice on how to improve your personal finance so you can focus on the things that matter to you the most. Again, as I mentioned in the beginning, today's episode is all about the fundamentals of investing. What is the difference between mutual funds and ETFs? So when selecting between investments, you are faced with two options, mutual funds and ETFs. Both are generally the same when it comes to they are pooling of investor money. So many individuals just like you pouring their money into a single fund, and that fund goes out and then purchase something. Now, it can either be active or it can be passive. Generally, mutual funds can have some active approach and passive approach, while ETFs are generally remains passive. So let's focus on some of the benefits on mutual funds. Mutual funds generally are larger. They are more widely spread. So for those many of you who have 401k at work, generally your funds are invested in mutual funds. So what's some of the benefits of mutual funds? Mutual funds are first of all are easy to own. They are fairly low cost and they are very well diversified. So imagine if many individuals pour millions of dollars in a single fund. That single fund now has a lot greater purchasing power. So they can go and buy different stocks and funds versus if you went out there and purchased a specific amount of stocks. So because you only have much less and much smaller amount of money that you can invest. So first of all, the diversification that you can have by owning mutual fund is significantly greater, which a lot of the time is very beneficial because in a downside market, if one company is being impacted, well, a lot of the time you still have many other companies to help offset that. The way I also like to think about it is like, imagine you had two elevators, one with a single string, and that elevator represents single issue stock. If something happens to that string, that elevator goes down. You know this. Now, imagine a different elevator. That elevator represents a mutual fund. That elevator has on average anywhere between 200 to 400 stocks, and each one of those stocks represents a string that holds that elevator. So even if one company is not doing so well, the elevator still generally is going up. Now, the second benefit of having a mutual funds is the fact that you are working directly with a company. Now, the purchasing of a mutual fund happens usually at the end of the day. That's where the price is set. There's no fluctuation of pricing like stocks or ETFs. So that's why the price is determined by the end of the day. Now, a lot of the times also when working with mutual funds, you need to remember that active funds, their goal is to outpace the market performance, which means that you have a professional money manager that selects the stocks that consist within the fund, within the mutual fund, with the intent of outperforming the benchmark, which usually is an index. Now, you might ask yourself, what is an index? An index, let's say, is the mark, is the value that what the investment professionals try to compare themselves to. A lot of the time it can be like the S&P 500, it can be like the Russell 2000, some general index or funds that are basically indicating of the health of the economy. So the second thing, as I said, you have the benefit in active mutual funds to have a professional money manager. Now, the third benefit is, of course, the easy reporting. So in mutual funds, you will get a statement generally at the end of every quarter, so every 3 months, and one summary statement at the end of the year, which makes things a lot easier. And last thing, of course, is the fact that mutual funds are much less volatile. And we discussed it a little bit earlier, of course, in the point of diversification. However, although it sounds great and you are right about to rush to go and buy a mutual fund, remember, they are still more expensive generally than ETFs or some passive index mutual funds. The general reason being is because active funds have a lot more trading in them, which result in a higher cost to them. And that cost can be as expense ratio or load, which is the specific terminology stated by the fund. The other thing is that mutual funds are generally not tax efficient. Because of the excessive trading, in order to try to outpace the market performance and giving you what we call a positive return, there's not so much tax efficiency, which generally results by less trading. So now let's go back to ETFs and see what are the benefits of ETFs and why you might consider ETFs. So ETFs are exchange traded funds. As I mentioned earlier, they're generally more passive in their approach, which means that they are trying to mimic a specific index. A lot of the times you can find, let's say, an S&P 500 ETF. Now, the greatest benefit about ETFs versus mutual funds is that they are traded like stocks, which means that they are traded on the stock exchange, and you can buy an ETF in the morning and sell it in the afternoon. So you can have a price benefit and price fluctuation that you can take advantage of. Now, the second benefit is that you don't have to actually deal with a mutual fund company, and a lot of the time, because ETFs are passive in their approach, there's no also professional money managers who usually make the cost go higher. So as indicated, on the flip side, ETFs are more lower cost, more cost efficient. And of course, if you are the type of person who is also looking for tax efficiency, ETFs is also one of those things and help you with that. But here's are the drawbacks of ETFs. ETFs generally is for individuals who are more active in their approach, which means they enjoy trading, they enjoy seeing the market price fluctuation, and they are more okay taking executive decision, which means that they can decide whether to buy the ETFs in the morning, in the afternoon, and gives you a little bit more flexibility versus people who just want to buy and forget it. The expense ratio of ETFs is a lot lower, so that's definitely a benefit. But remember, if you're looking for a specific fund that maybe have the ability to outperform an index, then ETFs will never be able to do that. The second drawback is that because ETFs are traded on the stock exchange, a lot of the time they can be what we call a spread differentiator. So the difference between the cost to buy the ETF, which is usually the bid, and the bid and the ask, which is the cost that somebody is willing to sell the ETF. Alright guys, hopefully you got the basic information and understand the difference between mutual funds and ETFs. Again, a lot of the time it's just the answer relies in who you are as an investor and what type of investing you are looking to do. So if you have any information, make sure to, of course, subscribe to the channel, leave a comment, and I'm happy to answer any question that you have. And of course, if you want to join our private Facebook group, we have a lot of people who are there to support one another and to answer any questions that you might have. So, hope you enjoyed this. Leave a like, subscribe to the channel, and I'm looking forward to see you in the next video. Stay tuned. Peace.